Hey y'all, thank you for watching. I wanted to go over a few of the positions and say why I put the positions on. Some of them you'll notice are pretty arbitrary, to be honest with you, but um, arbitrary in the sense that it's just me looking at something and thinking, okay, that's kind of low, or that was a big move. Like that was outside of one or two standard deviations. I'm okay with putting this trade on and giving it, a couple of days or so before it becomes profitable, before I try and either get out or hedge it to capture or lock in profits or, completely eliminate the amount of risk that I'm holding on to. So I'll start with the first one. This one's kind of weird, and you can look. I'll expand a few of these now. This one I just closed at M2K Z2. That is the micro Russell 2000 index, and I had one contract, but I just closed that today actually. So it's still up there. I could use the filter and get it out of there, but I won't. But let's start with the /10YX2. That is November expiration for the 10-year yield. So the actual interest rate yield itself. And the yield, this follows the interest rate. So if you look at the mark right now, my trade price is 3.76. The mark is 3.873. So I should be up. Yeah, I'm up $17, $14 on the day. I'm down $16 total on the entire day. It doesn't show in, let's see, where is it at? It's 9 days till expiry. It expires at the end of the month. When you're trading futures, you have to pay attention to what day they expire. They don't decay with time like options do, but they do have expiration dates where it's the last day that you can trade it. So, but your broker may have you trade out of it beforehand, especially if it's cash settled, and you may not have enough capital in your account to be able to handle that position. But if you need more info on that, that's as deep as I need to go on that subject. Just know you'll need to trade out of it, as you get pretty close to the expiration date. You may need to change to like December. Like, okay, this is 10YX2. December is 10/10YZ2. But let's go through a few of these columns. Like I said, 10YX2 follows the interest rate. I only put it on because I don't see the Fed slowing down on their interest rate increases. And the only reason I don't see them slowing down is because I don't think the economic data that made them raise interest rates in the first place, I don't think it's gotten to a place where they feel comfortable cooling off the jets on increasing interest rates. So that's really the only reason why. And I saw that it had a pullback. And once I go over to my year to date, it's a 50-50 shot. So like I said, I just put it on because I'm like, okay, well, it's at 3 point something. I don't think that's going to last. I think it's going to go back up some more, just because I don't think the Fed has enough data that would make them feel the need to cool inflation, since they are essentially setting the cost of money. So they're setting the cost of money based on economic conditions, whether they're needing to cool down spending or they need to stimulate it. So right now they're not stimulating it, they're doing the opposite of it. So as you can see, my profit loss year to date is 415. I've been trading each expiry. This only shows the profit loss year to date for the November expiry, but I've been trading November and September. I was trading the other other months before as well. So when you look at profit loss year to date, it's only going to show just a piece of the puzzle. So you can take some of these numbers as arbitrary if you want, but here's all the things that I'm trading. That's the 10Y, that's the 10-year yield. This is the S&P 500 futures. This is the mini futures. This isn't the micro. Mini futures options for June 2023. This was the contract that I closed today for the Russell 2000, and this is the micro Russell 2000 for December 2022. I had put that trade on again because it was really, really low. I thought that I mean, it was arbitrary. I felt like I was getting a good deal. And because I felt like I was getting a good deal, I put it on. But because it's a contract, it was a 50-50 shot. I actually put this one on with it. Well, I've had multiple that I had been putting on with it to hedge that risk. So I really only made for December, with it. I mean, sure, it came up positive. I try to do this each futures expiry. I'll have a contract running, and then I'll also be selling stuff against it. So I kind of wait for like I said, it's arbitrary. I wait for what I think is a good enough deal that I could go long this security, and then I will sell contracts, call options, or call spreads against it, and I structure my deltas in such a way that I am essentially lowering the amount of risk that I take, but I'm also lowering the potential amount of money that I could take. Because I know you could look at this and see, dang, he lost $757 on that, and he only made $1,000 on this one. So that means he only made not even $300, on that particular security, because he's using that to hedge. Similar to this, I bought these. This is a long position, and the MES, that's the micro S&P 500. And I just sell naked calls against it. I sell naked calls against a long position, and I structure the deltas in such a way with risk that I'm comfortable with taking. Honestly, I should have been doing this a lot more, a lot sooner with most of the positions I had, but I wasn't really paying attention to the Federal Reserve as much as I could have. I was literally just only paying attention to statistical probabilities, which can work, but it takes a lot of work if you're trying to manage multiple accounts, and if you're managing someone else's account, you can really hurt yourself too, because you may not be willing to take the same amount of risk in their account that you would in your own account. But anyway, so like I said, I put this on because I thought I got a good deal. I think I did a whole video about that one, the /ES. I just told you about this and the RTY. That's the Russell 2000 Mini though. The contract was the micro, and this was the mini. So this is a larger product. So when you structure deltas in something like this, it doesn't show, but I got two. I can use the S&P. So this one, when you structure deltas, if you're looking at the options chain, right? Whatever number you see, you got to multiply that by 500 for this one. So to have the same, because what you're trying to do is have similar amounts of risk or comparable amounts of risk. Notional risk. So what I'm doing is I'm basically making it so that my deltas are fairly close together. So if you don't have a high risk appetite, and you think about it, these numbers are dynamic too. They're not the same every single day. So that's one point I needed to make. And also, even though I'm holding this contract, they don't beta weight adjust this one. So that's why you don't see any delta there. But anyway, back to these two that I've just expanded. When you're doing an MES contract, you're trying to maybe hedge a longer term ES contract or something like that. Like I said, for the ES, you multiply the delta that you see on the options chain by 500. For the MES, whatever delta you see up there, you multiply that by 50. And it's the same for the Russell, the micro Russell. So this is the micro Russell, but I didn't have options up there, and they don't even have options up there, so it doesn't even matter. But to hedge it properly with this, these have options, so you have to multiply whatever number you see on the delta on the options chain by 50. So I'll just show you a brief example because this video is getting kind of long. Let's go to ES. So let's go to MES. We go options. So we go here, and I'm gonna just go to the position that I have. So you can see it says 0.25, right? It doesn't show the third decimal place. Maybe I'll contact Tastyworks and see if they could do something like that. Maybe I can get them to, add something to the platform, or at least on the desktop. It might show, I don't know. But right now it says 0.25 for the delta, if you see. If I go back to my position, I go to MES. Remember I said the multiplier is 50. So I can do 0.25 times 50, and that number will equal, well, the real number, the 3 decimal place, would equal what you see on the delta right here, that minus 12.33. But let's double check that math just to, boom, 0.25 times 50. So we know that 0.25 isn't quite the actual decimal. It's probably something a little bit smaller. If you need the actual number, you can just do 50 divided by 12.33. Whoops. 50 times, no. It's, let's see, we're doing it from reverse. Do 50. It's 0.2466. Sorry, y'all. My brain wasn't working. I'm hearing banging and clanging around here at work. But yeah, this is just, I just wanted to do a quick screen record. I didn't even know my phone could do screen record. It only records what's on the screen. I actually don't even have a camera in this phone at all. But I just wanted to do a few examples. Like you'll see, like at least in this account, in these trades right now, I've really only put them on for at arbitrary levels because they look like I felt like I was getting a good deal on these products, and these are leveraged products because they're futures. But the movement isn't quite as much. So since I work full time, I can't pay attention to it as much as I was before because I actually had a big change in my life. I used to be on third shift and now I'm on first shift. So I'm working when the market is open, and because I want to be a good worker, I pay attention while I'm at work. I just had a little bit of downtime now, so I figured I'd go ahead and make this quick video. And also, I didn't say why I put on this pin trade. I really only put this trade on because I wanted to have at least one fairly volatile stock in this account where I'm not risking a whole lot of money. I actually had a calendar spread on at first, so which means that I had a sold call. Like you see, I have this bought 40 call. I actually had a sold 42 call for an earlier date than that December 30, and I made money on that. And then I sold this and this. And so basically, the most I'm risking is $106, which is okay. And I'm risking $106 by December 30th. If this trade begins to be pretty profitable, then what I'll do is I'll sell another call, or I'll sell some more calls against it, maybe an earlier date, to reduce my potential max loss. But I'm giving this just some days to try and be profitable so that I can reduce my max loss. And I'll probably do if I get a big move, then I'll do, a far out of the money call that's probably before this date and just sell that just to reduce how much I'm actually risking on the trade. So I try and be fluid with it, but I just can't pay attention to it as much as I used to because, like I said, I'm at work. So until I can do this trade full time, I know a whole lot more than what I let on, especially on this channel. But I'm not holding back information on purpose. I'm holding back because I just don't have the time to. And also, I don't have the time to also put on these strategies that I want to put on. So I have to be real basic with what I'm doing, and I have to be mindful of the deltas, my portfolio deltas, when I'm putting these trades on. And so the cool thing about Tastyworks is you see that beta symbol, that B and that triangle, that's the beta weighted delta. They do an auto beta weighted delta to the SPY, but I honestly think that, I know at least on the desktop, you can beta weight it to any product you want, but it makes sense to do it on a product like this, like the SPY, because it's the S&P 500. It's considered like the benchmark, that everybody looks at when they're talking about market returns. So similar to how the 10-year yield is the benchmark rate that everybody sets their rates around. So if you didn't know that, now you know the 10-year yield is the benchmark that everybody sets their rate around. But like I said, I can't do all that I want to do in the trading realm because of my schedule, because I have an actual full-time job, and I actually enjoy my job. But one day I will. But the reason I structure my deltas in such a way, in this way, is because I'm batting for singles and not home runs. So, but I have quite a few strategies. I have quite a bit of knowledge in my head. I take this pretty seriously. I've learned from so many different places. If you've never looked at the Institute of Trading and Portfolio Management, I highly recommend them. And if you know what you're doing, you're really going to understand that those guys really know what they're talking about. I can't really think of, besides the OCC, the Options Clearing Council, and Tasty Trade. I can't really think of many places that I would recommend and say that they help me to specifically make money right away and explain concepts in such a way that I felt like I was able to impart that knowledge onto other people, because I was a coach I still coach, but I've been coaching for about 15 years, track and field. And so, one of the attributes as a coach that you want to have is you want to be able to, POP is probability of profit, by the way. You want to be able to impart knowledge in such a way that your students can understand it pretty well, and they can ask questions, and they can feel comfortable asking those questions, or they can have executable or actionable ideas to get behind. One more thing I can show you guys. I want to go to, I know this video is pretty long. This is uncharacteristic, but like I said, I'm pretty excited that my phone can do screen record. Every day I go to the investing app. There's actually a few more calendars that I look at too, but this one is just a quick, dirty way to see what's going on throughout the week. And I'll look at this calendar. I have it set to a filter for United States. I don't do as many foreign or international trades as I used to do when I was on third shift, and I was able to actually pay attention to the market a little bit more and be able to do more work. In other words, get more quality work in, versus now I'm having to nickel and dime how much work I'm doing. But I go through at the beginning of each week. I try and do it on the weekend. And I go through this and I look at any notable economic events that might interest me, or that I think are possible to move the market, or that I think could potentially move a specific sector that I might be looking at, or a specific future or something. And I go through this list, and like I said, I take note of it. I may write them down on a sticky note or something, or I'll write them down in my notebook, and I'll set an alert on this app as well, so that I can be mindful of things that are coming up. I also will put it on my actual calendar, my Google Calendar for my phone, so that it lets me know when these things are about to be reported. I really like to look at this. I think anybody who's known me for the past 2 years knows I've really since I want to say late 2020, I really like to look at CFTC net positions. I'm trying to see whether smart money is net long or net short, and where are they putting their money, and when they're switching from those net long to net short positions. Even though it changes quite a bit, it's still nice to be able to see some of those things. It's really beneficial, I think, for like cyclical, seasonal things, like you see these wheat, corn, soybeans, but they have specific international events that you may have to look at in order to be profitable in those as well, just because their supplies aren't only dependent upon the United States. So, you can see these positions and see what smart money is doing with them, but you also have to pay attention to certain news coming out. You may have to see which countries, have, how their harvest is going, stuff like that. So, you got to be kind of creative, but ideas are out there. The way I've been, looking at this market is basically just playing both sides, batting for singles, and sometimes in other words, not letting the longs run for too long if I don't see the Fed slowing down on their interest rate hikes. So don't be scared of this market. Don't be afraid to try some small trades. Options are great for having these awesome structures. If you know what you're doing, you can set a nice options trade structure where one can only lose its max if the other one does. You can set small deltas and cap your maximum loss while you're also capping your maximum profit as well. But it tends to be worth it if you are mindful of why you're putting the trade on. And like I said, sometimes me just picking an arbitrary number isn't always a good reason why. Sure, it works out. It's been working out quite a bit, but it doesn't always work out right away because, like I said, sometimes I have to sell something against it almost immediately if I think that that volatility isn't going to subside. Last thing, a trade that I've done that works in this kind of market. Let's see. I wonder if let's go to Samsung Internet right quick. I want to try to see if I have, I don't have it saved to this, remind me later. I don't think I have it saved to this phone, but if you can look up a matrix correlation calculator. Let's see, Samsung, what can you find? Let's see. I don't know if any of these will work, but let's try the first result that Google gave us and see. No, this isn't asking. How about this? Let's type in stock. Buy upside. I should have went to the first one. Oh, but this is a good one. This is actually one that I have used before. You can literally put in a whole bunch of symbols. This is why most of your trading gurus don't know what they're talking about. I don't want to say don't know what they're talking about. This is why people tend to be down so much. You got to realize that the people that may teach you, they may have so much money that they can just continue to buy as these symbols, as these securities continue to go down. They can buy into perpetuity. They can just keep on buying more and more and more. Completely, they're reducing their average price. They're increasing their risk, but they're just reducing their average price, when they're buying shares over and over again. So by default, they're in a different position than the average middle class American. You have to be more mindful of the correlation between sectors and symbols that you put on. And it's because when volatility increases, correlations increase even more. So that's why sometimes it may look like everything is down. But if it looks like everything is down, then think about it. If you were to be mindful of this, then why not put yourself in a position where you can go short one symbol and long another symbol that's already highly correlated? Now, this doesn't work in every single market because that's not true diversification. Doing it this way, true diversification would probably involve making sure that, these symbols are in different sectors. You know, this isn't true diversification. This is more so a hedge. So you can take some of these symbols, they automatically fill it in with these, with Apple, Microsoft, Google, Amazon, and Netflix. That's what they automatically fill it in with. Those are the FANG stocks. But I used a trade that worked out really well for me a little earlier this year. I put on what was it? Oh, Walmart. I put on a Walmart trade and a Target trade. Walmart is lower beta than Target. Target is more volatile. That's all it means. So don't let these specific Greek words, make you feel like I'm saying something super intelligent. I'm really not. But I put on a Walmart trade and a Target trade together. The Walmart was a long, and the Target was a short. I went short Target and long Walmart. And so, remember, I'm telling you why I put this specific trade on. Like I said, it doesn't work in every single market. Because here's the thing, you need a lot of volatility. Let me go ahead and preface before I tell what I did. You need a lot of volatility for this particular move to work. Basically, I used the calculator like this. I put in Walmart WMT symbol, and then I put in Target TGT symbol. I saw that these two, at the time when I put this trade on, they had a high correlation. And because they had a high correlation, I was like, okay, I could potentially, and I know one is more volatile than the other. I wanted to get some exposure to their sector, and because even with prices going up, my thoughts were that, the versatility of Walmart, the longevity of Walmart may not outperform Target, but if I'm always going to be losing on one and I'm always going to be winning on the other. So I didn't care, as I just wanted one trade to move in such a way that it covered the max loss of the other. So here we go. I bought a call spread in Walmart for $152. I bought a put spread in Target for $150. So the total amount of money that I put on for both of those trades was $302. $150 for Target, $152 for Walmart. And and y'all can see how to use this calculator. It's actually pretty simple. You calculate the coefficient, positive number. Let's just go ahead and do it right quick before I continue on. I'm going to just use these. So you can see when you look at this matrix calculator, the higher the number, the higher the correlation. So like Google and Microsoft have a 98%. You multiply this number by 100 to get percentage values, and that'll make it make sense to y'all. So I'll leave it on the screen while I'm explaining it. So the Walmart trade I put on, it costs $152 to put on that call spread. That's a bullish trade. And for the Target trade, it costs $150, and that was a bearish trade. It's a put spread. Both stocks immediately went down when I put the trade on. The reason I didn't care is because I wanted movement, and I wanted large movement. I wanted movement so large, I didn't even care which direction. I wanted movement so large and so soon. So in other words, I was looking for an opportunity. I can't remember exactly which economic event I used after going to investing.com, but I'm trying to give y'all an actionable idea so that maybe, something will ring a bell in y'all head and you may be able to capitalize on something. Because you think about it, this year, I was watching Tasty Trade the other day. I only watched it for about 5 minutes, but they were like, this year had some of the largest moves ever seen. As far as the frequency, the number of occurrences. So it's had the largest number of large moves almost ever seen in the S&P. So you can imagine that, actual stocks are, quite a bit as well. So here's the thing. I did, like I said, both of them immediately went down. Both trades immediately went down. So that means that the Target trade, the short trade, the put spread was profitable. So to make a long story short, it went down for a few days and I ended up selling it for $300. I paid $150 for it. I sold it for $300. So what is my profit? Anybody that's good at math? $150. I made $150. Now, if you were paying attention, how much did I pay? I know I got off track a bit, I'm sorry. But I paid $152 for the Walmart trade, which was a bullish trade. That trade was losing. I don't even remember how much it was losing by. I actually didn't even care. You want to know why? Because if I took a 100% max loss on that $152 Walmart call option spread, a bullish trade that I bought, a debit, even if I took a $152 max loss, it would still be a $2 max loss because I traded it in a pair with Target, and Target's winnings covered the majority of the potential max loss in Walmart. So the most I could lose if Walmart contract went to zero was $2, not including commission, by the way. So this happened within, like I said, it was almost immediate. So within 3-4 days, I want to say I was out of that Target trade. And after that, you want to know what I did? Because it was so volatile, that's what I wanted. I needed a big move. I needed big volatility. I needed huge movement just for this to happen. That's literally exactly what I wanted to happen. It's a risky trade, sure. But it's a risky trade that could potentially pay off with a big move. And you may need economic events. You need a catalyst that will move the market, something that market investors, maybe they're not expecting, or, some economic data comes out that makes people think, all right, risk on again or risk off, one of the two. You want to see, you want to see movement, you want to see big fluctuations, basically. And that usually doesn't happen in huge symbols like this. These are a little less volatile just because these companies are already so big. But anyway, that's another story for another time. But to make a long story short, never mind, my story's already long, but I'm gonna just go ahead and close right here. I ended up making money on the Walmart trade. It didn't take a max loss. Walmart ended up going up, and I ended up making money. So I made money. I made $150 on Target, and I don't remember exactly how much I made on Walmart. But the point is that I took two highly correlated symbols. I traded them around when it was getting close to a big economic event that I thought would create movement. I didn't know for sure. I don't ever know exactly which direction the market is going to go. I can try to predict it. I can look at, growth and PE and all that stuff if I want to. But for this particular trade in this particular market, big movement trades tend to help. And I just played the correlation game, and I played them together, one long, one short, and I just picked the one I thought would go up easier than the other. Like, it was arbitrary. Like, really, it was really a basic reason why I picked Walmart as the long and Target as the short. I'm like, okay, well, I didn't really look into it. I'm not gonna lie, I didn't really do much work, but I did put the trade on, and it ended up being profitable. So that's it, guys. Sorry for making this video so long, but I hope you got something out of it. I hope that in this 30 something minutes, something sticks, and you start to at least question some of the education that you're getting if you don't ever have anything that helps you to make money in a reasonable time frame. Everybody doesn't want to wait 10 years, 5 years just to see if they're right. But if you're a passive investor, there's absolutely nothing wrong with being a passive investor. But if you want to be a trader, if people talk about being a trader, then that's completely different. Because there's nothing wrong with investing either. Everybody doesn't have to be a trader. Everybody doesn't have to be in the shorter time frames. Everybody doesn't have to be fluid. Absolutely, you can make money as an investor. I'm only here for the people who want to be a trader and try and make some money in a decent time frame. And you're gonna have to lose some trades to get good at this. I had to lose some money. I had to take some L's in order to get better at trading and realize that, okay, I have to be fluid in the sense of strategy. I can't use the same exact strategies, going to a different shift or managing multiple accounts or whatever. I can't do the same thing all the time. I have to be versatile enough, and I have to be willing enough to train and work hard and learn different things as well. So that's what I did. I be working real hard in everything I do, and this is one of them, because I figure if I can get good at trading, then this could be life-changing for me and my family. So hope this helps somebody. Hope somebody is encouraged. Y'all take care. Thank you for listening. And